Okay, so let's talk a little bit about assets. So what are assets? Well, let's start by imagining somebody who wants to start a business. So we have our future business owner here, and he or she has some startup money. And if this business owner is like most business owners, his or her objective is to take their own money and use it to invest in a business and turn that money into more money. So a business at the end of the day is just like any other investment in that the whole purpose of acquiring a business, just like the whole purpose of buying a stock or the whole purpose of buying a bond, is to take your money and turn it into more money. Now, of course, there are many reasons why someone might want to be a business owner. It might be a lifelong dream of theirs to operate a restaurant. It could be that they find meaning in the work. It's intrinsically rewarding, the sort of joys of managing your own operation. But from an accounting perspective, from a strictly financial perspective, that's the goal. So I think it's sort of helpful to think of this to think of a business as like a machine. Now, this is our machine here. So the machine's job is to take cash that the owner invests in it and turn that cash into more cash. It's like any sort of input-output relationship. We're taking one thing and we're transforming it into another. In this case, we're taking the business owner's money and we're turning it into more money. Now, the money that the business owner puts into the business in the first place, when he or she first invests their money, the money going in is called contributed capital. Contributed capital. So capital, in this case, essentially means money. So it's money that the business owner contributes to the operation. Now, this money is used to buy assets. And the assets are really what the business is made out of. It's the sort of components of the business that allow the business to transform contributed capital into income, which is just another word for profits. And another word for them is earnings. So this cycle here, where a business owner inputs contributed capital, uses it to buy assets, uses those assets to produce some kind of product or service, which the business then sells to somebody for more money, and then that money comes back to the owner in the form of profits. This cycle is called the cash cycle. But before we get into the cash cycle, let's go into a little bit more depth about what assets actually are. So suppose that in this example we are running a restaurant. That's the business that we're founding here. So the business's assets, in the case of a restaurant, will likely be land. In other words, this business owner, if he or she wants to start a restaurant, is probably going to need some land to build the restaurant on. And then once they have the land, they can put a building on that land. And then once they have the building, they're going to need to buy some equipment for the kitchen. They're going to need some ovens, some stoves, some sinks, some tables, chairs. They're going to need some supplies. So some napkins and some straws, maybe toothpicks, tablecloths. And then finally, of course, they're going to need what in accounting is called inventory, which is really, which is an accounting term that refers to the physical, what goes into the actual physical product that you're selling. So in the case of a restaurant, the inventory is the actual food that you're selling. If you were running a shoe store, then the inventory would be the shoes. If you were running a clothing store, the inventory would be all the clothes that you're selling. In this case, the inventory is the food ingredients. So the assets in this example are all of the pieces of the business, the things that the business uses to generate income. So this actually leads us into a more formal definition of an asset, which we'll talk about now. Now, the formal definition of an asset is something of economic value to the business. Or actually, a better way of putting it would be anything of economic value to the business. Now, what does that mean? What does it mean for something to be of economic value? Well, in this case, in the case of a business, something is of economic value if it helps the business do its job, which remember is to earn income for the owner. So something is of economic value if it helps the business generate income. So anything, an asset is anything that the business can use or that a business uses to generate income. So, of course, each of these components that we discussed for our example of a restaurant meets these definitions because each one of these components plays some kind of a role in helping the business take the owner's cash and produce an output with it, and that output is our delicious meals, and then those outputs get sold in exchange for income, which then gets returned or becomes essentially the property of the business owner. So an asset is anything of economic value to the business that the business can use to generate income.